Alrighty. Brickworks.
Yeah, that's
So I don't
yeah,
remember exactly where we left off because we were going back and forth through Morningstar and this because we were getting confused about which were the correct numbers, right?
yeah. So
I
I
think we
think it
stopped kind of
was
around here, right?
yeah. So it's like the operating income was negative on the Morningstar website, but if you look at the annual report, they're all positive. So I think, and then I asked my friend about it, and he said, look at the annual report
Yeah,
because the way that Morningstar collects the data is not very accurate.
yeah. Which is, I mean, we've talked a little bit about this before. When in doubt, I use the annual reports or the financial reports. But this company, again, I mean, usually the numbers are a little bit off. This company, I
Mm-hmm.
mean, it's essentially like looking at two different companies, like we talked about last time.
Yeah.
So it's just interesting to me from that perspective. But we're gonna go. I'm gonna share my screen. Oh, and there's a whiteboard on. Let me try this. Can you see this?
Yeah. Yeah.
Okay, so that's
So that's similar to that's similar to iPad one as well. And I can also annotate as well.
Oh, you can too.
Yeah, yeah.
Oh, so that's interesting. I wonder if that's a new feature because I've never noticed that before on Zoom. So that's kind of cool. So I'm gonna play around with it
Right.
for a second. So okay, so yeah, no, I'll have to use this in the future too. Cool.
I thought you're gonna use a window. Are you gonna share screen and use a window?
Yeah, yeah, I
Wow.
was just testing that because I've never even seen that option before.
All right. Uh-huh.
Well, and I have two screens, but when it's like in my downstairs office where my kids and my family is sometimes,
Uh-huh.
so I can't do that very often. Okay, can you see
All
my
right.
screen? Can you see my screen?
Yep. Yep.
Okay, so again, when in doubt, we're going to use the annual report.
Uh-huh.
Something I was thinking of the other day, though, is this annual report is from end of year 2017, correct?
Yeah.
So they're essentially almost 1 year behind in terms
Yeah.
of data.
Yeah.
So in this case, what I would do is I would go to the company website.
Oh, and let's give you context. When we first started this, I think the share price was about $16. Now it's about 18. So 18.2. It's gone up about 15%.
Of course it
It
has.
always seems to happen. It always seems to happen whenever we do these case studies. It always goes up.
That's a good sign, though. Even though it sucks, it's a good sign that we're looking in the right areas.
Uh,
Okay, so 2018. Have they released their 2018 or their full year 2018 numbers?
shouldn't interim report. Yeah, it should have been out right now.
This is the one. No, this is the new one. So they must have just released this.
Yeah.
So
I
instead of looking at the one we've been looking at,
go to the go up and go to the invest. That's a flash file. Get the PDF. News and report. It's in the news and report tab.
there we go.
Yeah, and then go to annual report and GM. The annual report and AGM. And then the annual report. That gives you a PDF form.
Oh, so no, it's the same thing.
Same
It's
thing?
just, yeah, it's just this must have more information in it because the one's 69 pages and one is 139 pages.
Uh,
So it's the same thing. Okay. So they haven't released their most recent numbers. So let's go find their
let me get an ASX report announcement. That would have
quarterly.
yeah.
So when did they report? Do you know?
The annual 22nd of October 2018 is the annual report to shareholder.
Okay. So this
the
is
next
the
one.
most recent report.
Yeah.
So their annual year is a little bit off from most companies. Most companies report their annual kind of in the March, April timeframe.
That's for American companies, I believe. We only have you know how you have 4 quarters in a year. We have it like interim, and then we have it every 6 months.
Yeah, that's what most non-US companies do. They do only 2 reports per year, and that's actually what the US is looking at doing as well. Okay, so we're looking at the right report. Okay, so this is the most recent numbers we have available. So this should be EBIT right here, correct? So this has 230 million. What was EBIT on here? It was negative, and negative every single year.
Yeah, the operating margin negative, and operating income negative.
So what I would do in this case is I would go back. We already have 2018, 2017. I would get 2018, 2017, 2016, 2015, 2014 annual reports to get their kind of EBIT percentage or EBIT margin, their EBIT profit for those 5 years. And then I would divide those numbers by the revenue to get their EBIT margin. You understand?
Okay. But they're all positive. They're all positive.
So that's why
this positive
is confusing.
Yeah.
So let's just do it real quick on these 2 years. So 230 rounded up, divided by 821 rounded up. So their EBIT margin on here, according to their financial statements, is 28% versus, what was it, negative 16%. So there's a huge difference here.
Right. Maybe you can email Morningstar, ask them what the hell going on.
Well, and this is why when you're looking at non-US companies on Morningstar, you have to be very careful. And this is why I say when in doubt, always go by what the annual reports say. Non-US companies on Morningstar, you will see this problem on occasion.
Right.
Again, the numbers aren't usually this far off, but they are off sometimes, and more so on non-US listed companies. I don't know why. I mean, they should have pretty much the same data. They should be able to scrape the same data from the same information. But for non-US companies, this will happen on occasion. So in this case, like we've talked about, and I don't think I'm recording yet. Am I?
Yeah. I see a recording, bro.
Okay. So in this case, again, like I've said last week and this week, we're essentially, Morningstar has what looks like a terrible company, and their annual reports and financial statements make it look like a really good potential investment.
Right.
So what we need to figure out here is, I'm going to completely forget about Morningstar in this company's case.
Right.
Which again, normally I do after the kind of initial preliminary analysis. But this is something else you need to watch for as well, because just based on this preliminary analysis, this company looked terrible, right? The only reason we kept looking at it was because of what you said about this being a conglomerate holding company, and it owned different parts of companies, and I wanted to show you the valuations.
Right.
How to do that. So that's something else you need to be aware of as well.
Yeah. I had a quick look. If you go up, it's quite interesting. If you look at the gross profit, it's like 254 million. They're only positive because the share of net profit of associate and joint venture, if that wasn't in it, their EBIT would be negative. Can you see the share of net profit and associate?
Oh, yeah.
So that's probably why Morningstar has a negative number, because they back that out. And then,
Yep.
Does that make sense?
Yes.
So if you exclude that, then you'll get a negative EBIT.
Should we, that's a good question. So should we include this number in this company's actual EBIT calculation or not?
I don't know. I don't have much experience doing this. You'll probably have a better guess than me.
So what we need to figure out is they talk about this in note 2.3.
Right.
So what if you see something like this in the future? Let me see if there's anything else. There's nothing else that's kind of majorly distribution expenses. This seems large here for
And the selling expense.
the kind of company they are. Yeah, these two seem large for the kind of company they are.
Well, a brick company, isn't it? Wouldn't it be expensive to distribute?
Yeah, but don't they get most of their revenue and profits from the other entities though, if I remember right, or is it still mostly the?
Oh, right, yeah. They do the property development. Yeah.
So this is interesting though. So if this is truly the case, that these two take up, what is that, like
50%?
50% of their expenses?
Yeah.
Is their Brickwork side of their business, is the Brickwork side of the Brickworks business, should they sell that side of the business? Is it even profitable, first of all, which we'll figure out here shortly? If it's not, should they get rid of that and go into full-bore property development and owning this other company and go into a full-bore holding company situation?
Yeah, they're not doing that because they just bought a U.S. subsidiary brick company.
Yes,
So
which we talked about last time. So what we can do is we can figure out down the line here if they should be doing that, if they should be expanding to the U.S., and if they should own their entire Brickworks kind of operation at all. Because if it's not profitable, why own it? You're essentially, if you're essentially sustaining an unprofitable business by owning these other assets right here. That's essentially, if that's the case, that's essentially what they're doing.
Right.
Which, I mean, that's about 150 million, and so essentially they're only earning $50 million here. Or is that the net number? No, that's the net number.
That's the net number.
So yeah, no, so like I keep telling you, this company is awesome from a case study perspective. So yeah, so we'll go to that. So what I was getting to, and I got off track there because I started looking at the numbers.
I don't understand the share of net profit of associate and joint venture. Is that actual money coming in?
That's what we're going to go to note 2.3 for. So if I see something like this, and I'm not really sure if it's kind of real money, quote unquote.
Yeah.
I go to real money and see exactly what it says.
That's probably property development. 2.3, right?
Okay, there's note 1. Okay, 2.2, 2.3. Okay. So they don't really tell you much about it, but what does this sentence mean to you?
Equity method. They take out the debt.
Essentially what it means is it's based on the percentage of the companies that they own, the subsidiaries that they own. When you see something when you see the equity method, and it's talking about accounting, which this is, it means essentially the percentage of the company they own.
Okay, right.
These are their profits based on the percentages of those companies that they own. So I'm assuming, again, we'll go up and figure this out in the statements for sure. And there's even more notes here. So 6, let's actually just go down to the notes right now, and then we'll come back up here. So 6.3. Oh. 6.2.
Oh, that makes sense now.
Okay, 6.3.
6.3. Yeah.
So here we go. Here's that number.
Oh, that's the dividend from the shareholding, not really.
Yes. So would you include this portion, not the whole 100 million, just this 100 million right here? Would you include this in the actual profit for the company?
I probably would, because they're holding on to it. They've been holding on to it for 30 years.
Yes, and I would too. So not only do they have a great relationship, or supposedly great relationship with this company, long-term relationship at best.
Yeah, and they're earning each other apparently.
This is essentially cash. They don't have to do anything to earn this money. So this is essentially cash flow, correct?
Right, pretty much.
Do whatever they want with it.
Mm-hmm.
So the other one was 6.3B, right? Okay, so here's their joint ventures.
That's a property developer. 50% of the property developer.
So would you include this $100 million in actual profit?
Yeah. It's actually real cash. It's real cash, right?
Yes, essentially, unless they are, this is their portion of the profit.
Mm-hmm.
So, and this is even after tax profit, you'll see here. So this is essentially net profit. So this isn't even operating profit.
Mm-hmm.
So I would include both of these, but actually the 200 million number that's up here further
might be a bit.
It's a bit low. Because that's after tax. EBIT is supposed to be before tax.
Right.
So where are we at here? Okay, so this number right here is probably a bit understated because it's after tax.
Right.
And again, this is saying before income tax right here. This is operating profit right here. But they're saying, so they're kind of, I don't know if they're being conservative here, but the numbers aren't necessarily 100% correct here, because these numbers are after tax, but they don't even take taxes out from here until right here. So this is another perfect example of why people don't like value investing and they don't like looking at financial statements, because
it's a lot of work.
It's a lot of work, right? I mean, we've spent including today, after today, almost 4 hours probably by the time we're done with today, looking at this company's financial statement. Yeah. Again, 4 hours isn't a huge amount of time if you're looking at putting up real world money to invest in a company.
Yeah, that's true.
But in general, people are lazy and they want to take the easiest path. That's why people rely on the PE ratio, which I think is crap, a completely crap number. But it's easy to look at because every financial website reports it pretty much as soon as you type in the ticker. So you'll see PE ratio. So what I would do here is I would note that these numbers right here are likely understated, which would mean that EBIT down here is also likely understated, correct? Mm-hmm. I would leave these numbers here for valuation purposes to be conservative, but I would also do another valuation. What's the typical corporate tax rate in Australia?
I think it's like 30% or something.
Okay, so what I would do for my kind of base level valuation, I would use this number here. But I would also say, blah, 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 blah. These were before tax, and you should add about 30% worth of value to them, to this number. Actually, let me think about that. So I think the reason they state they're after tax here, and correct me if I'm wrong, because this might be different in Australia, but when you pay dividends, you pay taxes on them, correct?
Yeah. Oh, yeah, you pay 30%. Yeah.
So that's why they're saying it's after tax here, because they have to pay taxes on this level right here. So never mind. I would just leave this number here.
Oh, that makes sense. Yeah, that makes sense, because the they've already paid out 30% dividend.
Yes.
Oh, the tax on the dividend.
So, and again, 30% in difference, if I would have gone through with my thought process there, we would essentially, for kind of a high level valuation, we would have been off by 30%, correct?
Mm-hmm.
So that's, again, that's why what we're doing here is so powerful. Because even then, I've been doing this for 12 plus years, and I even just had to catch myself from what we were talking about there, the thought process I was going to go through there, because that valuation would have been incorrect.
Right.
So, all right, let's keep moving on. So actually, let's do a quick valuation real quick. So 230 times 8, that's 1.84 billion AUD based on this is a consolidated financial statements. And that's, again, with a conglomerate or holding company, you want to make sure the consolidated financial statements, if you're valuing the entire company like this, you don't want to value the kind of individual entities and then add the value to that, because you'd be double counting. So this is 1.84 billion AUD is essentially what I value this company's operations as a whole at, including investments.
What's the multiple?
The 8 times multiple.
Okay, all right.
So including their Brickworks operations, including their property development, including their investments in SOL.
Okay.
I value their operational value at about 1.8 billion AUD.
That's including the shares in Brickwork, right?
That includes the operational value from all these entities, not the actual carrying value, which we'll see below. I already saw that mentioned.
Yeah, but the dividend from the shareholding in Washington WHSP is included here.
Yes.
So if you value the whole thing at 1.8, then you can't revalue it again, because then you're essentially taking this is essentially all the cash flow, pretty much.
Yes, this is essentially the cash flow value.
Right.
So let's keep going.
Is 8 times conservative, or?
That's about what I figure. I find most companies. That's about kind of the base level value of operations that I do. I used to do 5 times. That's way too conservative, that I found. I used to do 14 times, but I only use that for companies with huge competitive advantages. So right now, for the past several years, what I do is I value companies' operations typically at 8 times multiple and 11 times multiple.
Okay.
11 times multiple is if a company has some competitive advantages or patents or something like that that's ultra valuable.
Okay. Yeah.
So comprehensive income, don't really care about this most of the time. So 21 million AUD. So I would add this to the value. So rounded up, that's 180. So that's 1.86 billion AUD. And I would subtract out debt. So so that's about 1.5 billion AUD. That's what I'd value the company's operations at, net of debt.
Okay.
Does that make sense?
Yeah, it makes sense.
At the 8 times multiple. So this is what we'll talk about in a bit too. All right, so they do derivatives a little bit. This might be interesting as well.
Is that a liability or is it an asset?
This is a deferred income tax liability, but we'll talk a little bit. This might be a good source of investment float there.
Retained profit?
That's another terminology for retained earnings.
Is it actual money?
Have we talked about retained earnings before?
I think you mentioned it. Is it like working capital?
No. Essentially, retained earnings or retained profits, whatever they call it, is money. It's like the way I like to term it is retained earnings are kind of like a rainy day fund. Do you guys have that phraseology in Australia?
Yeah, rainy day fund.
Like a savings account type of thing?
We'll call
So
it Mojo.
essentially, retained earnings is the actual profit the company has earned throughout its entire life of the company. You'll also see if it's
Okay.
negative, you'll see the term accumulated deficit.
Okay, got it. Yeah.
You pretty much always want to see this going up over time because if you don't, the company's losing money.
Right. So in this case, it's gone up. So
Yeah.
and
So
it's quite substantial.
generally a good sign. Yeah, by about $100 million in the last year.
Right.
Reserves, interest. I don't know what that is necessarily either right off, unless, so we'll see the note there. And I know I've talked with Mateo about this because we've done these kind of sessions on companies before. Most people hate looking at the footnotes because, again, you have to deal with this kind of crap. Footnotes to me are the most important part of any financial statement because it has this kind of information in it. And if you know what you're looking for, you can spot major problems or potentially major hidden assets as well.
Well, that's some really interesting information there.
Right here?
Yeah, like the whole thing.
Yeah. So again, we'll look at reserves later. We'll see what they term those as. Okay. So these are just a different way. These can be confusing. I almost always get questions about these when we go through them, like with Mateo or any other student. It's just they're reporting it a different way, what goes into these numbers specifically. But essentially, it adds up to what you see these numbers here and these numbers here.
Mm.
Okay, so cash flows. Why am I highlighting these right here?
This account receivable or something?
Yes, essentially, yes.
Accounts
Accounts receivable and accounts payable is essentially what these are.
So they're taking more money than they are paying to the suppliers.
Yes,
And
which is good, but the reason I'm highlighting it is because the numbers are so close together. So from their Brickworks, and again, I'm assuming these are Brickworks until we get to the actual notes talking about this, they're only making a profit in terms of cash flows of about, what is that, $80 million?
yes.
But when you add in the dividends and distributions received from their joint ventures and the shareholders they own, that's where they get the other money from. You see there?
So they pretty much get most of the money from dividend.
Yes. So that goes back to the question earlier that I had, should they even be in the Brickworks arena? By the cash flow statement, it looks like they're making about $80 million a year in that. So, I mean, what's the size of this company again?
What, you mean the market cap?
It's like a $2 billion market cap, something like that, right?
It's like 2.6, 2.7. I'll have a quick look.
Okay, so essentially what we can do with these numbers here is, let's just say 80 million divided by
2.73.
So their profit margin in terms of cash flow from the Brickworks arena compared to their market cap is about 3%. So that means they get more than 50% of their profits from dividends and distributions. They get, actually, it's about 60% of their of their profitability from dividends and distribution.
So they lose money.
So another interesting part here. So because of the arena they're in, it's a high operating expenditure business on a regular basis, correct?
Yeah.
I mean, you have bricks. I mean, you have to have cement or whatever bricks are made out of, and you have to continually make new newer bricks.
Mm.
So that's a high capital expenditure, high operating expenditure business.
Mm-hmm.
This is interesting. Purchase of investment in joint ventures. So they spent about $70 million more this year versus last year in investments in companies.
Just developing the land or something?
Could be. So this is where some of their cash flow came from too. Like we talked about last time, where are they getting their profitability from? They got $33 million from sale or return of investments.
Well, what did they sell? The shares of
what is it, the SOL company, I think is what they said.
Yeah. They sold like 200 million or something. Or maybe 100 million, I can't remember. Quite significant.
So here's another significant portion right here. Debt, what we talked about last time as well. So when you factor all that in, you get about negative 60 and negative 66 million in net cash flow per year, correct? At least at this stage.
Yeah. What's the net increase or decrease in? How did it go from negative 65 million to positive 21?
So this is the net increase on a increase or decrease on a year-to-year basis. So this is how they get from this number.
Right. Yeah. So they're pretty much breaking even.
Yes. Do you know why?
Dividend, I don't know.
They're pretty much breaking it even because they're having to spend so much money on their Brickworks business, and because they purchase so many. They purchased $81 million in investments last year. So on a cash flow basis, they are essentially breaking even this year. Is that necessarily a good thing or a bad thing? Not necessarily. If they're investing well, it can be a good thing. Like Buffett, for example, he has an $80 billion cash buildup at Berkshire Hathaway because he can't find investments that fit Berkshire's model. But when Berkshire was a lot smaller, they had a lot less cash because they were continually finding new investments to invest in. So it's not necessarily a good thing or a bad thing. It's a matter of is management doing a good job allocating capital or not? If they are doing a poor job, this is a horrendous thing because essentially they're just destroying capital. To me, again, at this point, it looks like they're allocating capital pretty well. We'll get to that stage when we calculate ROIC because I don't trust Morningstar's numbers anymore to figure that out for sure. But at this stage, I'm going to assume they're doing a good job allocating capital.
All right.
Okay. Okay, so here's where we get to some of, not necessarily financial engineering because that has a negative connotation to it, but some of the ways they're reporting positive cash flow. And again, it's not necessarily a bad thing that they're doing, but you take this out here and they're essentially not making much money from operations, correct? Because this is net cash provided by operating activities before changes in assets and liabilities. Actually, you take out this number and this number, and they're essentially on an operating basis not making any money, correct? And this is where you have to be careful on the cash flow statement sometimes too, because they invert the numbers oftentimes on the cash flow statements. So if you see something like this, it's not necessarily always a negative. If you see something like this, it's not always necessarily a positive. Does that make sense? Okay, so you take these two numbers out, they're essentially on an operating basis about breaking even.
Yeah.
Okay, let's keep going. And here's where they do it again. So increase, decrease, decrease, increase.
That's confusing.
Yes, it is.
Well, why would a decrease be? What?
They do this because these are assets up here, and these are liabilities down here.
Oh, right, got it.
So, and again, you take this out, this out, this out, this out, and they're essentially not making much cash flow. So what's keeping the business alive, in most part, in my opinion, is their investments in other companies. Does that make sense?
Yeah, but that happened like 30 years ago.
Yeah, but no, but they're still getting cash flow from the dividends.
Oh, right.
So this is kind of a scary thing, because if that company goes down, this is kind of what we talked about last time a little bit, what we were kind of alluding to last time. Let's say there's another major recession next year. Pretty much all companies around the world, and brick, what's main use of brick in Australia? Is it to build houses, I'm assuming?
Yeah, commercial, residential.
Okay, so if there's another global recession starting next year, and it hits the housing industry around the world really hard like the last time did, don't you think that this other company is going to slash their dividends?
Yeah, I think it'll be affected as well. The other company is quite much more diversified than this company.
And that's where the problem lies, because essentially this company is getting most of their cash flow from their dividends and investments in these other companies. And their other company, their other investment is in property development. So they will get hit hard too. So if there's another global recession anytime soon, and this company or those two entities have to slash their distributions and dividends to Brickworks, their profitability and cash flow is going to be either almost non-existent or zero. And if a company has no cash flow, it essentially has to do what it's already doing: issue more debt, issue more shares, or to pay its bills, or it goes bankrupt. So essentially what I'm saying here in the long way, I'm explaining everything, hopefully you're understanding it, is if there's another recession anytime soon, this company's in danger of going bankrupt. Because there's no margin of safety in the cash flow here.
What about in the balance sheet? But they don't have much cash in there.
They didn't have much cash on the balance sheet. If I remember right, they had like 22 million AUD.
That's nothing, right?
So there's essentially no margin of safety here with the cash flows. And if they don't have the cash flow, they can't pay bills. They can't pay suppliers unless they issue more debt. And the debt will be at higher rates because they're in trouble. They're needing to service debt. So this is why, I'm not going to say all value investors, but why I consider cash flow to be more important than even operating profit, and far more important than net profit. Because if you can't pay your employees, you can't pay your suppliers, you can't pay your debt, you're in massive trouble.
Right. Okay, got it.
Does that all make sense? Do you have any questions about all this? Because this is super important stuff.
No, got it. All good.
All right. So essentially here, and Shafiq, I think, was falling in love with this company again, like he was with IDXY or whatever it was.
Yeah.
This company looks like a decent investment now, and it probably is going to be a decent investment when the stock crashes during the next recession. Yeah. But would I buy it now? There's no chance in hell I would buy this company now.
Yeah.
Because again, there's literally zero margin of safety here.
Just by looking at the cash flow.
Just by looking at the cash flow statement. There's pretty much zero margin of safety here. Because think about it. Let's say these other companies get rid of this number completely.
Right.
There are essentially, they would have to, so again, I'll show you right here. So essentially, what is this? Combine these two numbers right here, 85 and 43. That's what, about $130 million.
What's,
130 about $million. So that leaves about $40 million, $41 million left over here. Most of that isn't even a real factor because it's from depreciation and amortization on their equipment. So that's not even a real kind of cash flow number.
Right.
That's an accounting number, correct? In most cases. So they essentially have a margin of safety because they only have about $21 million on the balance sheet in cash. They essentially have about $10 million of cash flow that is kind of real world cash flow. Does that make sense? Does that help illustrate the point of why I said there's no margin of safety here?
Yeah, I was getting a bit confused. Like, well, this whole thing to explain where the profit after tax is coming from.
This is the cash flow statement. This doesn't have anything to do with profit after taxes. That's the income statement.
This is cash flow statement. They said reconciliation of net cash, net profit.
Where are you looking at? Oh, right here.
Yeah.
Because the cash flow statement starts up here. Typically, this is a little bit backwards, and I don't know if it's the U.S. is backwards or not. But typically in the U.S., cash flow statements start with the net profit up here, and then they go down. So what they're doing here is just a little. Again, I'm not going to say backwards isn't the right word because I don't know if it's a U.S. thing that's backwards but how I kind of learned to view cash flow statements is starting at the net profit up here and then going down from there.
So is this? They say the net profit is $175 million, and then they adjust it based on a whole bunch of other non-cash items.
Yeah, they get this number from the income statement.
Right.
And then they go down from here.
But why would they subtract share of net profit account? Why would they subtract that? Is it the 50% thing?
Yes. Yeah. Because the share of net profit, meaning their share, and then using the equity method. Yes.
Okay, got it.
So, yeah, and if you're confused even a little bit, let me know because, like I said, this is super important stuff. So, did that help when I kind of broke it down and said that they getting rid of these kind of accounting numbers here and here, and this is a real number, but subtracting that because assuming, and again, you always have to assume kind of a worst case scenario, and that's not even necessarily a worst case scenario. Companies, if there's a recession and they're hit hard, it's generally a fact they cut dividends first.
Right.
It's just a general fact because that's one of the easiest things to cut. Unless for this company, but this company would be even in a more dire situation because they've done dividend increases for 30 straight years, I think you said?
Yeah.
So what they would likely do in this case, again, they have almost no margin of safety in real accounting numbers, about a $10 million margin of safety when you take out their dividend and their kind of non-real world numbers, correct? So what this company, because they've raised dividends for 30 straight years, if these other companies cut their dividends, what they would likely do, and I would say it's almost 100% certainty what they would do because I've seen companies
maintain it, right? They'll
maintain their dividend or increase their dividend. They would take out more money or they would dilute shareholders further. Or both. I've seen both happen just so they could remain on those, what the dividend king list or whatever they're called, because people invest just based on those lists.
Yeah, people invest in Australia based on dividend yield.
So what I can almost guarantee with 100% certainty that is what the company would do. Instead of cutting the dividend like they should, they would dilute shareholders and or issue debt to keep them on those lists. Especially because you said in Australia, people will invest. Again, this is the thing in the U.S. as well. But you said it's even a bigger thing because of the franking in Australia. People invest for dividends a lot in Australia. So I can almost guarantee with 100% certainty that's what they would do. So moving on. So we've covered what? 2 pages in about an hour. No, got on about 8:15, 8:30, right? So in about 30, 45 minutes. So how important do you think this, again, 2 pages is right here? And understanding fully kind of what it means in a real world sense, more importantly, and kind of what it helps you figure out.
Yeah, I think it's really nice that you break it down. Like you get to see the full picture. Whereas if you just focus on one thing, you don't get to see the full picture.
Well, thank you for saying that. But I meant for you, how important do you think this is, like going forward?
Like you mean the cash flow or what?
No, just for you, like in your long-term kind of value investing kind of stuff.
Right.
How important do you think this is?
Well, I want to be able to read like a financial statement.
Yeah.
In its totality. Yeah.
Yeah. Well, and I mean, you get a huge advantage over other people doing this because they'll just kind of, even if most people won't look at financial statements at all. If they do, they'll just kind of look at the financial statements and just kind of gloss over them and look at the numbers. So you get a huge advantage over other people by actually knowing what things mean on a deep level. So you're getting over time, you'll gain a massive advantage over other people by knowing this kind of stuff and being able to spot potential red flags or, again, potential hidden assets. Okay, so let's go to the notes now. Okay, so they work with IFRS, which most non-US companies do. We've talked about that before, right? GAAP versus IFRS.
Yeah, I think one's an American standard, one's a international standard.
Yeah, most non-US companies follow the IFRS. US follows GAAP. I think at some point they're gonna kind of merge. There's not, in my opinion, there are differences, but they're not that much of a difference. So it's not really a huge deal. But again, and that brings up a point. So there are differences. So what are the kind of things you need to watch out for? What I tell even my close friends who take accounting classes in college, I know an enormous about real world accounting and what it means. But I guarantee you, if I take an accounting class in college, I'd probably fail it.
Oh, really?
Because I don't know what the actual terms mean in kind of the book sense, like the definitions mean in the book sense. I know what they mean kind of in the real world experience, like what I just told you. So if there was a test based on what does this mean, like what is the definition of this, I could give you the real world definition. I couldn't give you the book definition. But so what that goes back to, what are the differences? In my opinion, as long as you understand kind of the stuff we've already talked about and you know what to look for, the differences between IFRS and GAAP don't really matter too much. That's another question I get quite a bit is, what should I look for versus these two accounting standards? In my opinion, it's more important to know not necessarily what the standards say, but is the company following the correct rules kind of in a real world sense?
Okay.
This is interesting. So you almost never
judgment.
What does that mean? Judgments or estimates? What does that mean?
They guessed it. They fudged the number. They guessed it. Why don't they just get someone to value it or some shit? It's not that hard. Just get someone. So
this is important because when people think of accounting, they think these are 100% correct numbers, right? They're not. There is an enormous amount of gray area in accounting standards. And essentially, if your accountants are good enough and your lawyers are good enough, you can make your numbers say whatever you want.
So why don't you just get some third party to like value it properly?
Because even then, what are we doing when we value any investment?
We compare. We make judgment, right? Okay, right.
We're making judgments. I will never say a company is worth X, Y, Z specifically 100%. I will say it's worth, in my opinion, this range based on these numbers and these factors and my biases. So essentially that's what they're doing here. And this is what all accountants do in every single financial you ever read, is there are judgments and there are estimates. There is no, and I've seen Warren Buffett talk at length about this, accounting rules as they are currently set up, there's a lot of gray area where you can kind of maneuver. But even Buffett has said he doesn't know how to fix it. He doesn't know of a better system. So what you have to rely on is, again, this comes back to my number one rule in investing. You have to be able to trust managers. If you can't trust managers at the company that they're doing conservatively and as they're supposed to be doing things, this is another example of why I will not invest in them, because there's so much room for error here, or so much room for estimates and judgments in accounting rules.
Right.
Well, and here's another kind of real world example is there's a lot of talk about socialism and in the United States now, and there's a brand new congresswoman in the United States who wants to tax people at 70%.
Really?
Yes. So
I think people are getting pissed off by the rich getting richer.
Yeah, that's essentially what it is. So, but that will never happen. Even if they institute a 70% tax rate on the ultra rich, it will never happen. They will not pay 70%. Because there are so many loopholes and kind of gray areas in accounting, and they have the best accountants. That's how Amazon, I just read this article the other day. That's how Amazon, for I think the second year in a row, has paid 0 taxes on its U.S. operations because it has so many net operating loss carry forwards, and its accountants and lawyers are so good.
Oh, really? So they pay no tax?
And they're the second biggest company in the world.
They pay no tax?
They paid no tax.
Like, really? Like, ever?
Well, they paid sales tax and stuff like that, but no income tax.
Oh, right.
Because essentially they are not making profits on a net profit basis. So again, that's why we use operating profit, because you can make the net profit number whatever you want.
Mm-hmm.
Okay. Go away. Okay, so they're almost 100% in Australia. They do have some operations outside of Australia, but not very much.
Mm-hmm.
And that will change because, or it should change, because they bought a U.S. subsidiary, correct?
Yeah.
Okay, so here's where they break down things. And this is fantastic. Most companies don't do a chart like this. Most companies, you have to kind of just parse through the information. So why this is so fantastic is
Well, you
because
can see the division.
we get to see what each entity is producing.
Mm-hmm. Go investment.
In terms of profitability. So we can, if we wanted to, and we don't necessarily need to here because they have a full number here, is we can, if we wanted to, we could see what, like if they wanted to sell the Brickworks portion, for example, we can not only put a value on that company, we can put an EBIT percentage on this company as well. So this company's EBIT percentage is below 10%, correct?
Mm-hmm. Mm-hmm.
So it's not producing, in my opinion, it's not producing a high enough rate of return. I look for anything over 10% on an EBIT percentage basis. You can't really do the same thing here because, again, these are distributions and stuff like that. So you can't really do the same thing here in terms of finding an EBIT percentage, but you can still value this individual entity here. So unallocated expenses, so significant items, I would want to know what that is. Borrowing costs, that makes sense. Other unallocated expenses. So I would want to know essentially.
Admin costs or some shit. Administrative costs.
Well, that's what I would want to know what these two numbers are. These $48 million. I would want to know what these are. And it doesn't show that they're talking about a note here, but they should talk about it somewhere. We'll get to that in a second. So here's also what's interesting. Assets per segment. So there's $1.1 billion worth of assets in the building products, 500 million in that segment, in the property segment, and 1.3 billion in investments. So again, their property and their investments make up, what is that, 1.7 rounded up? So what is that, about 60% of their total assets? So this company, in my opinion, based on the information so far, why are they in the Brickworks arena at all?
I think they've got like a legacy business that they're too.
So let me rephrase that question. Are they trying to get away from that business and diversify away from it and become a true holding company? Or have you read, because we haven't read that part yet. Do you know what their kind of long-term plan is? Does it become more of a holding company, like an actual holding company, or has it become like just a brick company that owns these other assets? Or are they going to try to build on these other assets in time?
No, I think I think they want to continue being a brick manufacturer, and then they want to diversify their income, their earning to Europe and America and all that crap, but then they have the investment and the property division to smooth out the earning. So this is interesting. That's what I think management said. Look into the webcast. That's what management roughly said.
Okay, so this is interesting to me because this is essentially, you probably saw a smile come across my face. Warren Buffett's biggest failure as an investment that he bought is what? Do you know?
Berkshire Hathaway.
Yes. Do you know what they did before?
The textile?
Yes. They made textiles. They made shirts and clothing and other stuff like that. Warren Buffett, by his own words, says that is his biggest failure as an investment, is buying Berkshire Hathaway.
That's why he didn't change the name, right?
Yes.
Remind him every day.
That's one of the reasons he didn't change the name of the company, because he wanted to always be reminded of not to buy companies that were cheap on the kind of a surface level, but they required ever more operating and capital expenditures.
Right.
So that's why he diversified away. That's why he is such a great capital allocator, because he saw that what was happening. And even though he kept that business, Berkshire Hathaway operations, open for probably a decade longer than he should have, because of the legacy operations, because he didn't want to get rid of all the pensions, because he didn't want to fire a lot of the old people that worked at the factories forever.
Yeah.
He kept it open 10 years longer, essentially because he was a nice person. He should have closed it probably 10 years before that, but he was a nice person. So essentially, what he did instead is he took the profits out of Berkshire Hathaway proper, and he invested in these other assets, insurance companies, See's Candy, these other assets that produce more cash flow that he could use to invest in these other assets. And that's how he built his massive snowball. And that's why Berkshire is worth over $500 billion today. If he would have
wasn't this company do something similar?
And that's what I was getting to. That's why I asked you what this company's long-term strategy is.
Look, they sold the shares in the investment. They went from 43% holding to like 39.3% holding in the very very stable dividend paying kind of, and then they use that to buy another brick manufacturer in America. Doesn't sound very smart.
So essentially, what this company is doing is they bought these other assets instead of going the Berkshire route, getting out of the legacy business where you're not making much money. Essentially, what this company is doing is the exact opposite. They're buying these other assets to keep these operations going, to make the company look more profitable. So they're doing the exact opposite of what Warren Buffett did.
Why is that? Why do you think so?
They might. Are they? Do you know if they're a family-owned company? Are they the founders or?
The founder is family-owned, but he owns a large stake in this. So
they're probably emotionally invested in the brick portion of this company.
Well, the name Brickwork, right?
Yeah, I mean, yeah, exactly. That's a perfect example. Is the company Brickwork. So what they're likely doing is they are emotionally invested in this company. They know what's happening, which is why they own these other investments in property management. But they don't want to do the hard thing and get rid of their brick operations and become a full-fledged kind of holding company.
Yeah, I don't see that happening.
So this is super interesting because I'm working on the capital allocation stuff with Shafiq, right?
Yeah.
So this is the exact opposite, or this is the exact model that most companies follow. They don't allocate their capital well enough.
Mm-hmm.
And I mean, they could and should, in my opinion, be doing exactly what Berkshire Hathaway did. If they had somebody who knew what they were doing with capital allocation, well, they would essentially tell them to phase out the Brickworks operation and invest in other assets or entire other companies to diversify their operations, build more cash flow, and build a giant snowball.
I would argue if they sold the Brickwork, the building product segment, then the management would lose their job, and like freaking people
And that's
will lose
another
their
problem.
job. Yeah.
That's another problem. So,
Am I right?
yes, no, and that's another reason probably why they won't, is because they're emotionally invested. They founded Brickworks. They're emotionally invested in the company. They've been doing it for what, 30 plus years, you said?
Yeah.
So there's two huge factors. Emotions are probably number one in this kind of situation. That's another reason, what you brought
I think a management fee was like $7 million a year or something. It's a huge remuneration.
That's insane. And we've talked about that before with Australian companies. That's insane. Because essentially what they're doing here is they're misallocating capital in a massive sense.
Mm-hmm.
And I can illustrate that here.
Fair.
They're essentially earning $200 million from their property investments in operating profit.
Yeah, okay.
They're only earning about $80 million here, but their operating margin here is, and I'll calculate it out because I know it's under 10%, but I want to get the exact number. So 76 rounded up divided by 820 rounded up. So it's about 9.2%. So essentially the goal of capital allocation, proper capital allocation, is to invest in the highest and best used assets that's going to give you the highest return, correct?
Right.
Essentially they're investing in these high profitability assets, invest money in their lower quality, lower return assets. So just by kind of definition, they're taking money from here where they're earning high returns or high returns here.
They took money from investment. They took money from investment and pumped it into building products.
Yes. So essentially they're taking money from high return assets and investments and investing it in low return assets. So they're automatically destroying capital.
And they're paying tax because if the investment, if you're selling a share that you've owned for 30 years, you pay a fuckload of tax.
Yes. So that's another problem that they're doing. So this is super interesting. Because essentially another way to put it is they're investing, and again, you can't really measure the EBIT return here, but let's say it's 20%. They're essentially investing and getting a return of 20% here in this example, and they're investing in an investment that's giving them half the return. That makes no logical sense, correct?
Yeah.
But companies do this every single day because A, they don't know nothing about capital allocation. If they do, they don't know how to do it well. So that was B. And C, because emotion is involved. They don't want to get rid of this Brickworks asset. They don't want to transition away from it because it's their baby, essentially.
Pretty much.
That's why Buffett had a huge advantage when he bought Berkshire, because even though he was a nice guy and kept it open probably 10 years longer than he should have, he eventually shut it down because it was making no money. You can't run a business that's essentially unprofitable. And again, they're making profits here, but they could be earning a lot higher profits if they were to invest in these other assets.
But I think they don't have. If they sell the building product, then they would have no way to put the money, except maybe property.
Well, and that's another thing too. Is because again, like I just talked about, most companies don't understand capital allocation. So these guys started Brickworks. They probably don't know anything about what we're talking about right now. They probably know nothing about it. They probably just bought these other assets to diversify and to be able to get dividends and cash flows. They probably don't even know that they're earning half of their return or more from the Brickwork side of the business.
Mm-hmm.
And this is a billion-dollar
I'm pretty
company.
sure they know. I'm pretty sure they know, but it's just like it's
But
a
they
lot
can't
of like
trigger.
conflicted interest in like this.
Well, they're founders, so they've been there forever. They've been there 30 plus years, so they probably know the employees. They don't want to fire the employees. They don't want to get rid of the pensions. They don't want to take the public relations hit of laying people off. So all these emotions come into play with this kind of stuff. And I'm not going to say it's easy to sit here and do it, but again, as a public company, if this was a private company, they can do whatever they want with the money. It's their company. They can do whatever they want. But as a public company, you have a fiduciary responsibility to do what's best for your shareholders. Mm-hmm. They're not doing what's best for their shareholders, in my opinion. Because again, they're essentially destroying capital automatically once they take it out of the investment and property business and putting it into the building products business. They're essentially destroying 10% of their capital every time they do that.
Right. I don't think the American brick manufacturer is going to generate really good high operating margin.
You don't think it is, or you think it is?
I don't think it is. It's probably
no, and I would agree with that, based on what we're seeing here.
But you never know. If you have a look at next year, see how it goes. But yeah.
So this is all, again, awesome from a case study perspective. So let's see. Keep going up here. So, and I mean, this fully illustrates the point right here. Versus, look at this.
There's no carrying value, essentially.
There's essentially no value in the business, according to how they're accounting for it on the balance sheet. There's no value to the Brickworks business.
That's the whole asset minus liability.
Yeah.
So the investment is actually has the most value.
Yes, these two right here, at least according to the carrying value, make up almost 95% plus of the value of the company.
Mm-hmm. And they're selling that.
And this is the acquisition you were talking about, correct?
Yeah. They pretty much sold some stake in the investment to buy.
So again, that's where we're talking about the misallocation of capital. So they essentially sold money here, or sold, what was it here? Investment?
In the
which is a high return, low cost, low expense business, to invest in a lower return, high expense business. Why would they do that? Do you have a guess?
I'm going to guess empire building.
Yes. Again, which is what? Emotional most of the time. Yeah. They want to get bigger in their main line of business, which again is their baby.
Yeah.
They want to expand to the big market of the United States.
Mm-hmm.
Perfect wording, empire building. So is it likely, in your opinion, based on what we've talked about, that this is going to be a good investment for the company long-term, buying the U.S. subsidiary?
I don't think so, because management kept talking about diversifying their earning in the bloody webcar.
Okay, so that's a key phrase there. If they're talking about diversifying earnings just for the sake of diversifying earnings, that's a problem. If they say something along the lines of, we're doing this because we expect this to be a good long-term investment because this will add to our company's profitability, that would be a good kind of example of what you would want to hear. If they're talking about diversifying just for the sake of diversifying, that's not a good thing.
Well, so I think it's sort of justified it by saying America has a better structure for business, lower tax rate, like lower labor costs, all that shit. But
and that's fine, but and it might be true. I'm not sure. Versus Florida, because you said it was in Florida, right?
No, they have places all over the world, all over America.
Oh, okay. So it depends. Different states have different tax codes and tax regulations and laws and stuff like that here. But that's fine. But again, if they're talking about diversifying in terms of sales, which is, I'm assuming, what they're talking about, they want to broaden their sales and they want
probably
sales. That's not profitability. You don't want to build sales just to build sales. I think I told Shafiq this the other day. I would rather own a company that has a 10% profit margin than own a bigger company that's 10 times bigger that only has a 1% profit margin. Because if you, again, like we illustrated in the cash flow, and this is another way to illustrate that point. If you're not making profits over time, you're eventually going to go out of business, or you're going to have to dilute shareholders, or you're going to have to issue debt. So this entire picture here, and Shafiq, if you're watching, no, I would not buy this company. I'm looking directly at you because there's no margin of safety here whatsoever. I hope this illustrates the point of why. Yes, it's an interesting company to look at. Yes, it's fantastic that we're learning all of this. Yes, on the kind of surface level, it looks like a fantastic company. But there's when you kind of boil down the numbers, and again, Shafiq, I'm talking directly to you if you're watching this. There's almost no margin of safety here for the profitability, especially when you account for a future recession and a dividend come from these property and investments operations. There's almost no margin of safety here.
So you worked out it's 1.5 billion. You put the value on the whole business.
What was that?
You said you estimate the value of this business to be $1.5 billion.
Based on the operating profitability, yes, about 1.5. Right. After debt and cash, yes.
Which is, its market cap is 2.7 now.
So that means, by my estimation, the company is massively overvalued. And again, that doesn't even account for dividend cuts in a recession. If the company, if the property and investment, if there's a recession that hits the real estate market hard, and you said real estate's already slowing down in Australia, right?
Yeah.
It's going to destroy this company's dividends that they receive. It will probably also lower. That's the reason I asked you about Australia's real estate, is because it will also probably have to cut that value in part as well. Because if real estate prices crash again, this could fall by 50%, essentially. And then what's the investment? I know it's an investment in another company, but what does that other company do?
It's like a mini Berkshire Hathaway. So I would say the dividend will be quite secure.
Okay, so the dividend might not be cut from here, but it would almost definitely be cut from here. So if I were to kind of guess, worst case kind of scenario, I would put discount, or I would discount this value by about 50%. Is what I would do. So in terms of that, that would bring the EBIT from here down to about, what was that, 46, 47 million? So what I would do, I'll actually show you what I'll do. So I would take the 76 number here, 6 plus 47 plus, let's say this doesn't fall as much. Let's say this one would fall by about 60% here, or fall by about 40%. So it'd have 60% of the value. So that would be, what, about 80 million, 85? So I've got a total EBIT of 208 million now versus 293 million. So times 8, that would give me about a value of 1.6 billion. After cash and debt, that's about 1.2 billion.
Right.
So that's essentially what I'd value this company's operations at today, based on, again, past experience, knowledge, and what the arenas this company in, valuations at or near all-time highs, and recession likely. That is likely what I would value this company at today, 1.2 billion, based on what we've talked about. And you
wouldn't even buy at 1.2. You buy at like 1 or
yes, I would want to buy under 1.2. So if it got to like 900 million market cap, I would be super excited.
Right.
So yes, no, I want, and that's a good point you had there. That's a good question. So when I report the numbers that I would want to buy at or under, it's always under that number. That's the number that I believe the company's operations are worth today. But I want a margin of safety under that. So I would want to buy probably under 1.9 billion is what I would want to buy underneath that number. Does that make sense?
Yeah.
So essentially, having said that, the company would have to fall. What'd you say it's at? 2.6 billion?
2.7 now.
2.7 billion. So this company would have to fall by, what is that? 60% almost for me to be even interested in buying the company.
Yeah, but then that seems very unlikely, because when that happens, the dividend yield will be like 10%.
Yes. And then they would also likely have more debt and have diluted shareholders by then too.
Well, wouldn't people mop up the shares if the dividend yield were 10%?
Well, the dividends over 10%. I mean, if a company has a general rule is, unless it's something like a business development company, a BDC, or a REIT, companies, if they have a dividend percentage near or above 10%, it means there's massive problems. It means the dividend cut is likely because it's unsustainable. Does that make sense, or I need to explain that further?
Yeah, all good.
Okay. So, again, Shafiq, I know you're falling in love with this company. Again, I just don't see it. And that's the beauty of value investing. You may see more value in stuff, which you did in IDXY and this company to this point. Maybe you'll change your mind after you see this video, because we covered a lot of the issues we were trying to figure out last time. But yeah, I just don't see it. And again, the misallocation of capital, especially, and I'm probably biased because I've studied capital allocation and proper allocation enormously. And B, because I'm putting that presentations together for this exact thing right now.
Oh, wow.
But that is it literally, again, and the best way I can say it is essentially they're taking capital from a high investment return, high margin business that requires low expenses and putting it into a lower return, higher risk, far higher expense asset. So essentially they're automatically destroying capital. So I just, especially with what Shafiq and I are doing right now with those companies are working to do, I just couldn't do it with this company right now. I couldn't do it because I don't trust that they are doing what's best for shareholders is essentially what it comes back to. Again, are they doing anything necessarily illegal, bad, immoral, anything like that? No. But they're not doing what they should be doing in terms of profit allocation and doing what's in the best interest of all shareholders. So this should be a good stopping point, Dave, unless you want to keep going.
Well, all good.
What did you think of this session?
I thought quite fascinating to get an overview of how you think about the business. And it's a really good discussion and explanation. I enjoyed it.
Good. I'm glad. And I love, frankly, I just love doing this kind of stuff, not only because I can see you guys learning as well, but because like I said, I'm learning as well. I had to catch myself on that one thing we were talking about, the dividends earlier. So I'm constantly learning as well and thinking through my own thought processes as I'm going through this. So it's awesome for me. I'm glad you are finding a ton of value in it. I love doing this kind of stuff. So,
so thanks for the session. I've got two quick questions I'll ask you. One is totally irrelevant, but I was having dinner with a friend today. He's like an investor as well. And he was saying how he did it. You know what the CFA course is, right?
Yes.
You have this 3 level. He said he finished level 1 and he said he just did it for fun. Just sort of like, like if he wanted to get work as an analyst one day or something like that. Study for 2 months. He said he read for 2 months and then did some kind of multiple choice test. Do you recommend those courses?
To be honest with you, at the stage I'm at, because I get asked this quite often, is why haven't I taken the CFA and gotten the CFA designation? I don't think it's really important for me at my stage. Because essentially I would be taking up a year of my time to get all 3 of the levels. And it wouldn't add much other than I'd have the actual designation. I would have, essentially in my opinion, I would spend an enormous amount of time and effort and money to get a certification. In your case, because you're starting and you might want a job in the analyst field, it might be something to look into. because not only will you be learning a lot from it as well, but again, you might want the designation to get jobs and stuff like that in the future. For me, where I'm at, again, I don't, from what I've read about it,
yeah, it's not very useful.
More about options and stuff like that I don't really care to know anything about, other than kind of the base level. I know what they are and I know what they're used for. I don't care about pricing options. I don't care about a lot of the stuff they talk about in the CFA course. So for me, I don't think it would be of much value to me.
Okay, cool. All good. Thank you for that. And next week, what company do you want to go? There's no point doing this anymore.
If you want to pick another company, go for it. If
Shafiq or Mateo, is he coming back?
Mateo, he's doing a bunch of courses and coursework right now and tests for finishing off his dental work and studies and stuff. So he said he'll be able to do stuff on weekends. He said he probably wasn't going to be able to do stuff during the week.
Okay. Well, why don't you get Shafiq to pick one then? Because I already picked one.
Yeah, Shafiq can pick one if he's going to be here. If not, I'm fine with you picking another company too, because you're picking some fantastic companies. So. Okay.
Well, give the options to Shafiq. If he's not there, I'll pick one then.
Okay.
Cool.
One of my little girls is up. The littlest one. Come here. Let me. Come here, baby. This is my littlest one.
She looks a bit like you.
Yeah, she's starting to look more like me. Say hi.
How old is she?
She's just turned a year old in January.
Oh, wow, congrats.
Thank you. Say hi, baby.
You make me want kid, Jason.
Oh yeah, no, I love my kids. I mean, it's such hard work and they're frustrating, especially as they get older. But they're awesome.
Awesome.
So yeah. Anyways, getting back to that stuff. Yeah, if Shafiq and Mateo aren't there, I'm fine with you picking companies. Otherwise, I'll have them pick a company, and I'll try if we can. I'll try to reach out to Mateo because I actually met with him for the first time in 3 months.
Do you want a property developer that where the net profit had gone down 90% in the last year?
That should be fun.
That could be interesting if you want to have a look at literally all the metrics have gone bad and it's getting sold off. That's quite interesting.
Yeah, that should be fun. But yeah, on weekends I'm usually busy with family stuff. But I may, if Mateo and Shafiq would like, maybe one day on the weekend or one time on the weekend we can do this. But that's up to everybody too. So.
Oh, cool. And I think this year I'm going to focus on reading books. So I have it's like 40 books you recommended in the masterclass. I want to get those done.
Okay. Okay. Yeah. Yeah. Do you have any questions about anything today or any comments or anything?
Oh, good. I understand. I understand all of you, what you said. It's quite interesting.
Awesome. And I'll get this video out if you want to watch up and download it and upload it and all that stuff. Probably later today or tomorrow. So you can watch it again if you want to. And I'll post it in the group as well. So.
All right. Cool. Awesome.
All right, David.
All right. I'll see you next week. And then
and I'm going to be in, let's see. I'm going to be in Spain with my wife. I'll be able to do next week, but not the week of the 6th, 7th, 8th. I won't be able to do that week. I'm going to be in Spain with my wife, and I might not be able to do the next week after because I think we're getting back to the 13th or 14th.
That's fine. That's fine. Just keep us posted on the Facebook group. Yeah.
But other than that, after that, we should be pretty much good to go for a while. So.
All right. Cool.
Yeah, I'm going to be in Madrid with me and my wife. We're taking our first vacation pretty much ever. So.
Oh wow! Congrats.
So yeah, it should be a fun thing.
Bringing the kid?
No, the kids are staying with Grandma and Papa, my parents.
Oh.
So yeah, just us. And we've been together 16 years now, and that'll be our first ever vacation, just us. So.
Oh wow! Congrats.
Thank you. So that should be fun. But yeah. So until next week, we'll start looking at that other company next week, or whatever company you want to look at. If Shafiq and David or Shafiq and Mateo don't respond. And then we'll go from there.
Okay, cool. No worries then.
Awesome, David.
All right. You have a good day.
You too. Talk soon.
Okay. Bye.
Bye.